Brace yourself because I know you hate it. Good news is bad news. Live from New York City this morning. Good morning, good morning. Equities heading south as payroll surprise to the upside. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, we begin with the big issue. It's Jobs Day in America.
The jobs data.
This month's employment report.
This surprise to the upside.
The story for 2022 has very much been one of the Fed and rates driving equity markets.
We're all subject to the data.
It's payrolls, it's CPI, it's the Fed into year end.
How the Fed reacts to all of these numbers.
But we want softer jobs. We want softer jobs.
The Fed is slowing the economy down. That's exactly what it's trying to do.
The Fed can't stop until the labor market starts to slow down.
We heard from Powell. They're going to moderate the pace of hikes going forward.
The Fed is going to look through it if it's a very strong print.
The labor market has not cracked.
What you see is stocks are down and bond yields are up.
Wages are still going up at a very rapid clip.
It's the wage data that's driving it.
We are not getting softer jobs. Mike McKee joins us now for more. Morning, Mike.
Yeah, John, it was a surprise to the upside. 263,000 jobs created, which is actually a decline because October was revised up from 261 to 284. So the last 2 months has seen more strength in the labor market than anybody anticipated. We do see 3.7% as the unemployment rate, same as it was the prior month. The participation rate drops a little bit. I'll get to that in just a second. But everybody in your roundup there was focused on the same thing, wages. Average hourly earnings up more than anticipated and up at a 5.1% rate, which is higher than the 4.9% in October, the revised number. So we're still seeing wage gains, and that's what the Fed doesn't want to see. Now, you can see here on the chart, some of that is base effects, but they should be going down now because the base effects in the most recent months are for lower inflation. And then you look at where we are, we're way above it. The green there is where the Fed would like you to be, between 3 and 3.5%. So 5.1%, still way too strong for Jay Powell and company. The numbers are showing it's the goods versus services wages. Powell was talking about services wages. Well, they were the ones that were up significantly during the month. They were up by 7%, almost 8%, whereas goods producing only 0.4%. So this is kind of exactly the story that Jay Powell described the other day when he said that service industries are the inflation problem right now. The interesting thing about the unemployment rate is that we saw the household numbers decline. Employment declined in the household numbers, but 186,000 people left the labor force. Not what you would expect around the holidays, maybe a seasonal adjustment problem, but it does suggest that there are still going to be job openings, a lot of job openings, according to the JOLTS numbers, and we're not getting the workers in the labor force to fill those. I note that the president is going to speak later this morning on the Railroad Act. I'm sure he's going to talk about the economy. He does have something to brag about, and that is for Black Americans, Hispanic Americans, and Asian Americans, the unemployment rate all went down significantly. It was only white Americans, and in particular, those without high school degrees, who saw a decline.
Mike McKee, thank you. We'll catch up with Secretary Walsh on some of those themes in about 40 minutes' time. Let's push that data through this market. Equity futures down by 1.5%. Equities down, yields up by 12 basis points to the front end. Your 2-year 435. Dollar stronger by 0.5% on DXY, back through 105. Joining us now to discuss, fantastic lineup this morning, Mohammed Al-Arian of Bloomberg Opinion and, of course, Queen's College, Cambridge, and BlackRock's Rick Reeder. Mohammed, first to you, sir, your take on a jobs number from 30 minutes ago.
So I would summarize what Mike covered really well in 3 comments. 1, it is good news for the economy in terms of jobs and pay. 2, it is less good news because labor force participation fell and inflation prospects are still worrisome. And then finally, it is bad news because once again, Fed communication has contributed to undue volatility in markets.
Rick, your take?
Agree with all of that.
So I think the one thing that's jaw-dropping, if you look at this number and you break it down, the service sector of the economy, look at 82,000 jobs in education and health services, 88,000 in leisure. The service sector of the economy, which is not interest rate sensitive, education is not exactly interest rate sensitive. The Fed raises interest rates. The goods economy, I would argue, is moderating significantly. I always find the markets focus too much, like in the 80s, when you had a goods-oriented economy. We have 80% of the jobs in the country are service-oriented. And you think about the demand that still has to catch up. You see this in airlines, you see this in restaurants, you see it in hospitality, you certainly see it in healthcare. That's hard to bring down. And by the way, not as interest rate sensitive. The thing that I think is critical is the interest rate adjustment. You see what's happening in real estate. That's having an impact. That's interest rate sensitive. The other parts of the economy, you see, boy, you got it in shining lights today. It's hard to bring down the service economy.
We're going to talk about Blackstone and what's happening in real estate a little bit later, so brace yourself for that. I'm looking at rates right now at the front end of the yield curve. The 2-year at 4.35. Now, Mohammed, we've got a move today, sure, of 13 basis points, but these aren't even the highs of the week. We started the week opening up the week on Monday at 4.45.46 on a 2-year. Mohammed, the reason we're lower on the week still on 2-year yields is because Chairman Powell spoke on Wednesday. Now, you went through this piece by piece in response, in reaction to the jobs number we got 35 minutes ago, Mohammed, and you said this Fed is contributing to market volatility. What is it that Chairman Powell did on Wednesday that you disagree with?
So I said it contributed to undue market volatility, is the undue part, excessive market volatility. Look, I think once again, the Fed did not understand the technicals. Once again, the Fed didn't understand the behavioral aspects of markets. So while Chair Powell went out of his way to be balanced, he did a few things that made the market hear just what it wanted to hear. First, confirm that we are downshifting in December. Second, do this ahead of the labor report, suggesting that maybe he knew something that others did not know. Third, talk about risks being now balanced, two-sided, and bring in his colleagues on the Fed. And then what he didn't mention, John, he did not push back in any way against what already was a significant rally in markets and a significant loosening of financial conditions. So while he said other things, and he was right to say other things, including warning about inflation staying, warning about our job not being done, he didn't realize where the technicals of this marketplace were, and he didn't realize the behavioral aspects. And that's why you got this overreaction, and now we're giving some of it back.
So, Mohammed, the equity market is basically back to where it was at the end of August when we heard from Chairman Powell at Jackson Hole. You talked about that easing of financial conditions off the back of the speech, the address from Chairman Powell earlier this week. Mohammed, do you think that means they have to go even further than we expect? And based on where you think the terminal rate's going to be, when they deliver projections on December 14th, how much higher up do you think that dot in 2023 needs to go?
So, John, it's going to be tricky. They've got a CPI report just before. It's going to be very, very tricky. I suspect that they will guide us to above 5. That's where I think they're going to be going. But this is really tricky. This is a situation where the Fed has to be very careful about what it communicates, because we don't need undue volatility. And when we come to talk about other segments of the market where there are already liquidity strains, we'll understand why you don't want undue volatility in this marketplace.
June projection for year-end 2023 was 380. September projection for year-end 2023 was 460. When we get the projection, Rick, for year-end 23 in December, is that a 5 handle? How much higher does that need to go?
In terms of the terminal rate?
In terms of the terminal rate, Fed funds 23 year-end in their summary of economic projections.
Listen, I agree with Mohammed chronicled it. I think they've got to get to about 5-ish. And by the way, I would comment on one part, because our last month on the show, maybe I was a bit animated about this because I think it's right. The chair, when he said at the press conference of the FOMC meeting, when he described this dynamic of we can over-tighten and then use our tools to bring it back, and I think I got a little animated. I think that's really hard to do. Unless you break a lot of structures, it's hard to do that. I thought one of the big changes at the Brookings was when he said, actually, we don't want to really do that. That's what some of that volatility was really, because you cut the tail off. And that was a really big deal, i.e. that you could go further and bring it back. That was a big deal for markets. Listen, I would go back to my point. I think they've got to get the funds rate to a level and then let it marinate through the system for a period of time. Put it on hold for a while. It is restrictive where you're gonna pause. And the interest rate tool is one of the most extraordinarily blunt tools today because it gets at some parts of the economy, not others. And you need to see how it's gonna react. But listen, I think the market's got a little overzealous across a series of things, and I still think they got to go to around 5-ish. But again, I don't think they need to go much further than that until you see the data subsequent to it.
Rick, you've nailed it. The shift from the November news conference to what we heard at Brookings earlier this week. In the news conference at the Federal Reserve meeting, he talked about asymmetric risk. This Fed has basically told us that they think the risk of doing too little is greater than the risk of doing too much. And if they do too much, to your point, they can just reverse it and cut interest rates. There was a shift this week, Rick. And given we had that shift, and given that you've just explained you think we've cut the tails off, do you think the tradable range for the 2-year has shifted lower off the back of what Chairman Powell said this week, regardless of where the data comes in?
So Jonathan, I mean, you're dead right. I mean, everything I get asked at all the events, conferences yesterday, all week, is where are rates going, what have you. I think there's one thing that's very, very different from where we were. I think rate volatility is going to come down because now we're not talking about 475 basis point rate hikes in subsequent fashion. Now we're talking about, are they going to do a 50? Maybe they do another 50, but they're probably going to get to some 25s. That's a really big deal. I don't think, when you get the 10-year note at 350, as it was pre this number this morning, or even 360 or 370, and you've got a funds rate that's going to be about 5. It's pretty hard to see it rallying a lot from that level. So what I think the big deal, and particularly the front end of the curve, I think rate volatility, that to me is the big dynamic, which has huge ramifications for other markets. If the volatility, the risk-free rate drives volatility down the credit stack, down the capital stack, and if that stabilizes a bit, it's good for markets. Again, I don't think it means big rallies in rates at all. But what I do think it means is a bit more stability than what's been an incredibly tumultuous year because of the risk-free rates moved so much.
If you have more confidence that you can price the risk-free asset, Mohammed, you should have more confidence that you can price risk. I get all of that. The problem we've had over the last 12 months is just how much Fed funds has moved relative to what we expected 12 months ago. Mohammed, you've always said about the need for humility in this cycle coming out of the pandemic. 12 months ago, this Fed had in their SEP for year-end 22, 90 basis points on Fed funds looking at 12 months. Mohammed, as you look out into next year, what do you think we need to be a little bit more humble about?
So first, I think we just have to be humble about how the economy will respond to the lagged effects of what we've already seen. I've warned, look, I'm not where Bloomberg Economics is, it's 100% probability that we fall into recession. But also I warn, be careful. Don't just say, oh, it doesn't matter because it's going to be short and shallow. That's the same trap as transitory inflation. Transitory inflation meant look through it. Short and shallow recession means look through it. No, keep your mind open. The other thing, I completely agree with Rick that we're going to see a decline in rate volatility, but understand that that is happening at higher levels of rates. And that's what you have to balance. Because while the rate volatility will come down, the higher overall absolute level of rates as the Fed keeps on marching up is going to have its own impact on the markets. John, I think we're mostly through interest rate risk. The qualification being the Fed must not contribute to more volatility by saying things that is better not to say. But we're going to talk a lot about credit risk next year and a lot about differentiation both across jurisdictions and within jurisdictions.
Well, you've mentioned liquidity risk several times as well, Mohammed. Can we talk about that a little bit more? Blackstone, I'm not sure how familiar both of you are with this story. I'm going to read out the lead paragraph from our write-up of this story today. I'm going to ask you both to respond to it if you can. Blackstone's $69 billion real estate fund for wealthy individuals said it will limit redemption requests. We're calling this one of the most dramatic signs of a pullback at a top profit driver for the firm and a chilling indicator for the property industry. Mohammed, when you hear that story, and the FT's done a nice write-up of it as well, how do you respond to it?
I'll tell you what I tweeted earlier, Jonathan, which is that this speaks to a much bigger phenomenon, When you run a financial system at very low rates and abundant liquidity, the financial system will optimize those conditions. And one of the ways in which it has tried to optimize those conditions is by offering liquid, relatively liquid products on illiquid asset classes. And we've seen that happen in several places, including in real estate. So when you offer relatively liquid instruments on illiquid asset classes, and the asset class becomes truly illiquid because the financial conditions change, you get what you're seeing in Blackstone. So I think there is a general lesson to be drawn here, and one that we also saw in a different way with the LDI, and we've just to keep an eye. They pop out from almost nowhere, but they speak to exactly the same phenomenon.
Rick, final word here. And does it remind you of 07? Because I've had that thrown around all morning from various people. Does it remind you of 07?
Only tangentially, and I wouldn't comment. I'm not going to comment on them particularly on what happened there. But I will say that this gearing that happens through the system, as Mohammed said, things that shouldn't be geared, Class B office real estate, parts of the leveraged loan market that are dicey in terms of, and you look at how now your interest coverage is declining in some of those spaces. That's where you got to be careful into 2023. The leverage in the system, household, corporate, bank leverage, is not like it was. Full stop. Not even close to where it was in 07. But there are places, and you saw it play out this week, that there are places in real estate, which is, again, why I think the interest rate tool, you got to be careful because it's blunt, and 3/4 of the wealth in the country by people is in the home. And so that's part of why I think, as Mohammed said, get the rate to a level. You got to let it marinate a bit at restrictive levels and then see where we are, because you can do some damage in what is structures that get levered in an environment where rates stay too low and liquidity is too high for too long. And that's the end result of that.
Hey, Rick, awesome to have you with us alongside Mohammed. We'll get a final word from you both in just a moment. Coming up on this program, President Biden avoiding a rail strike.
We're going to get it done, but not within this agreement. We're going to avoid the rail strike, keep the rails running, keep things moving, and I'm going to go back and we're going to get paid leave, not just for rail workers, but for all workers.
The conversation up next, plus reaction from the White House with the Labour Secretary Marty Walsh coming up shortly. This is Bloomberg. About 20-something seconds away from the opening bell. Good morning to you. Equity futures deeply negative. We're down 1.3% on the S&P 500. On the Nasdaq, we're down by 1.8. On the Russell, the small caps lower as well by 1.4%. Data beats to the upside. Equities drop like a stone. Yields take off at the front end, and the dollar a whole lot stronger. There's the opening bell. Switch on the board and get to the bond market. Yields look like this on 10s. Only up now by 6 basis points. The move fades just a little bit on the long end, particularly on 30s. Basically unwound the move. Post payrolls in the last 60 minutes on a 30-year yield, only up there by 3 basis points. The move sticks at the front end just about, up 10 or 11 basis points on a 2-year, 433. That's driving a bit of dollar strength into the euro. And I emphasize, a bit. It's not a major move. Euro dollar, a negative 1/3 of 1%, 104.84. And crude, $81 and about 60 cents. We're positive there by 0.5%. At the opening bell then, about 30 seconds into the session, let me break this one down for you on the S&P 500 and on the Nasdaq. We're negative by a little more than 1% on the S&P. On the Nasdaq, we're down by about 1.4. With the price action for you, here's Abby.
Well, John, this is a really interesting one because it certainly is not the Goldilocks report that traders have been expecting, but a beat of 63,000 jobs is much smaller than some of the other beats or misses that I can remember in recent times. It shows you how tightly wound traders are because, to your point, we do have stocks plunging. Take a look at the S&P 500 E-mini futures really showing it off the lows, but nonetheless down 1.1%. That index flirting with a possible decline on the week, and the big move in yields. Now, you are right, the long end giving back some of those moves, but the short end, to your point, still up 11, 12 basis points there on the expectation that the Fed will keep on hiking. And for the February meeting now, there's a greater than 50-50 shot that they may actually hike by 50 basis points. So a bit of a change there, weighing on big tech because, of course, a bid for bonds, or excuse me, a bid for yields going higher, price going lower, means that the dollar index is bid up. That's pressuring big tech. Valuation growth really comes into question. Speaking of the dollar, John, it's really interesting because we've had so many folks recently talking about the demise of the dollar. But on this report, there you have the Dixie finding support right around 105. There's a pretty good chance you could see a fast move up toward 108. If that happens, that could really pressure all the risk assets as, again, they become more expensive.
Abby, thank you. To continue the conversation, joining us now is iCapital's Anastasia Amoroso and PGIM's Mike Collins. So to both of you, first of all, just your reaction to the jobs number, which is 60 minutes old now. Anastasia, first to you.
Well, it still shows a solid labor market. And John, as you know, it flies right into the face of what the Fed is trying to accomplish, which is to see the cracks forming in the labor market. And there just are not at the point at this moment. And there's two particularly concerning things within the payrolls report, which is the fact that the labor force participation rate has declined, and also wages is still growing at 5.1%. And again, that's a step up from a prior month. So the Fed, of course, is trying to break this wage price spiral, and, you know, it just takes time. So the bottom line, and the reason why the stocks are in the red here, is that the Fed has to get to restrictive levels and they have to stay there for longer. And what we saw is a repricing in the bond market where rates are now below 5%. If you look at the projected Fed funds, and that's just not justified. So that's the repricing that we have to have because of the payroll report today. So I think it's fair. It needed to happen, and clearly it's just going to take longer to see the cracks form in the labor market.
Mike Collins, your take.
You know, Jonathan, I find myself sitting in front of this ominous picture of the Titanic this morning, and I'm really hoping it's not a metaphor for the U.S. economy and the global economy. And I think the Fed funds rate is probably the iceberg, right? And this report is a little disconcerting because, as we've feared, the services sector continues to be really solid. The consumer in general continues to be pretty strong. Services inflation, wage growth continues to be pretty sticky. And this may be a little more of a secular shift than what we've become accustomed to over the last few decades. So I'm worried about, in 12 days when the Fed comes out, Jonathan, with that new dot plot and those 2023 numbers, as you asked Rick and Mohammed. I mean, they're going to probably have a 5 in front of them, right, by the end of 23. And that's nowhere near what the markets are pricing in. The markets have gotten a little bit ahead of themselves in the near term here and are pricing in a lot of cuts at some point next year and ending the year with a closer to 4% funds rate. So it's the markets are a little off sides here.
So Mike, let's build on the markets and just sit on that just for a moment. I wonder whether you think, or would have thought coming into this jobs number, that the sell-off we'd get in equities after an upside surprise would be more proportional to the rally that we got on Wednesday off the back of Chairman Powell. We're only down 0.9% on the S&P. We had a monster rally on Wednesday. If you look at two-year yields this morning, we're only up, I say only, by 12 basis points on a two-year, and we're not even at the highs of the week. In fact, we're about 10 basis points off them on a two-year at 435. And as we often say, Mike, you can learn something from the data. You can also learn something from the way the market responds to that incoming information. What are you learning from this morning?
Yeah, what I'm learning, Jonathan, is the markets maybe got a little bit ahead of themselves. I mean, when that 10-year kind of dipped below 3.5%, and you're going to be in a world where the funds rate is going to be at 5 not too long from now. Now, that's a really big stretch, right? So we're kind of fading that. And equities, I would put in the same category, maybe got a little bit ahead of themselves here. Credit is probably in the same boat. Spreads have had a huge rally here. We're generally fading these rallies across all of the assets, but you don't see a big sell-off here because this wasn't a huge number. We didn't see a giant miss here. I mean, it just shows that the economy is okay. It's not falling apart, at least in the U.S. The job market is solid, right? We have a shortage of workers in the world, Jonathan, right? And that's going to keep wages sticky, keep job gains pretty good. Companies are really reticent to let go of all these workers they've been fighting to find. So I think it's a little different world than we've been accustomed to, and earnings have kind of held in. So yeah, I mean, it's I think this whole soft landing, mild recession scenario is probably increasing in probability.
You've said that a lot over the last couple of months, Mike. I've heard you say it a few times. The resiliency of this economy, Anastasia, has surprised many. You've got the front half for 23 as this part of the calendar where you think there's going to be a better entry point for equities next year. Anastasia, what is it about the front half of 23? Because we keep hearing the same thing from a lot of people about the same time.
Right, John, as I think about these markets, I mean, we've been in this sitting and waiting and wishing mode, and we've been wishing for inflation to fall down. We've sort of been also wishing for the slowdown that we've all been anticipating to finally happen. And I do think that is very likely to happen in the first 2 quarters of next year. I mean, typically you think the yield curve inverts and, the Fed ends the rate hiking cycle, and there's still some time before the onset of a recession. But what's different this time is typically the Fed doesn't hike into a slowdown, but they've been doing this all along since June of this year. So, Jonathan, I think this recipe for recession has been in the making for quite some time now. It is really kind of ready to be fully baked here. So if you look at the economic projections, we're expecting slightly negative GDP growth in Q1 and Q2. And so Q1 in particular could be problematic because, you can have the economy that's notably weakening. I mean, we already had the manufacturing gauge slip below 50. So you have an economy that's weakening, but the Fed, to Mike's point, they're not going to stop hiking rates just yet because of service inflation. I absolutely think 5% is going to be in the dot plot in December. So we're going to get to 5% rates and the economy is weakening. That is not a good mix of outcomes for the market. So that's why I think it's very likely that we'll retest this 3,600, if not below. But as I think we move further into Q2, that's when this gap is likely to open up between where the Fed funds rate is, which should be at 5% or maybe north of that by June of next year. But the inflation, the core PCE inflation, I suspect does begin to come down, and projections are for 3.8%. So we finally going to have this gap where the Fed is actually well ahead of the inflation curve. So when that gap opens up, I think that's when they will eventually pivot. So that's why the first half and the first quarter in particular is likely to be treacherous, but that is likely to be the entry point into risky assets, because once the Fed has the gap, that's when they'll be ready to pivot, and that's when risk assets can finally catch a break.
Why aren't we pricing that now, would be my question, Anastasia. I hear it from you, from UBS, from JP Morgan, from Morgan Stanley, that first quarter is where we get pain. Now, as Lisa mentioned earlier this morning on surveillance, this is meant to be an anticipatory asset class. Why aren't we discounting some of this stuff right now?
Oh, it's still so far to go, John. I mean, patience here is going to be a virtue, and this is still a 6 months out sort of an event. And I think that's why the markets have been trying to discount some of that, but this is a very tactical market. I mean, you really can look out, a couple of weeks in advance or maybe a month in advance. And, what everybody I think has been discounting now is the Fed is likely to slow down the pace of increases. And by the way, I still think that's going to be the case in December, 50 basis points, despite the payrolls report. But what comes after that is still quite uncertain. So it's just, the crystal ball is not all that clear 6 months away. So it's far too early to discount that.
Mike Collins, final word here.
Yeah, to Anastasia's point, the markets, Jonathan, to be clear, are pricing in that soft landing, right? They're pricing in the worst case, kind of a mild recession. They are not pricing in this more draconian downside, harder landing scenario. And even though I don't think that's my base case, man, there is a reasonable probability that the Fed screws this up again, that a 5-handle funds rate is way too tight, in conjunction with a tightening balance sheet, and that the whole thing ends up rolling over much harder than we expect. And earnings expectations are still way too high for next year. And you have a deeper, harder landing next year. That is not being priced into the markets, which is why we're kind of fading risk assets here.
Mike Collins and Anastasia Amoroso, to the two of you, thank you. And Mike, special thanks to you, buddy, for waking up early on the West Coast. Thanks for doing that for us. We appreciate it. They're going to stick with us. Coming up, hiring and wages keeping the pressure on the Fed.
It is good news for the economy in terms of jobs and pay. 2, it is less good news because labor force participation fell and inflation prospects are still worrisome. And then finally, it is bad news because once again, Fed communication has contributed to undue volatility in markets.
The brilliant Mohamed Al-Arian earlier this hour. Equities down about 1%. Coming up, we get the view from the White House with US Labor Secretary Marty Walsh. Looking forward to that conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Diane Swank, chief economist at KPMG. That conversation at 10 a.m. Eastern, 3 p.m. in London. This is Bloomberg.
Live on Bloomberg TV and radio, I'm Jonathan Ferro. I'm pleased to say that joining us now from Washington is the U.S. Labour Secretary, Marty Walsh. Secretary Walsh, fantastic to catch up with you, sir. Another strong jobs report. As you know, this has been a very, very strong labour market in America, and Labour is meant to have the leverage in this world. And Secretary Walsh, we've got to go to the union question. Should unions have the right to strike?
Absolutely, unions have the right to strike. I think unions have the right to strike in almost every collective bargaining agreement. In this particular case, your next question will probably be about the rail, so I'm going to anticipate it. The National Railway Act has a provision in it that allows the president to get involved in negotiation when asked, and the unions asked him to get involved in this. He put together a presidential emergency board. They came back with some recommendations. I had that 20-hour negotiation in my office. We added some more benefits to the contract. It went in front of the members. 8 of the unions voted for it. 4 of the unions voted against it. I tried to get both sides to stay at the table and negotiate over sick time, and there's some work condition rules as well. They weren't able to get to an agreement, and the next step in the Railway Act is Congress to take action, and that's what they did yesterday.
Well, I'm pleased you anticipated it, because you said it all at once for us. On the one hand, you think they should have the right to strike, and on the other hand, you take away their right to strike. Can you make sense of that for us?
Yeah, well, I mean, it's the way the law is, the Railway Act is. And, you know, when I look at this contract, we spent a lot of time, I spent a lot of time myself, but the unions in particular, spent a lot of time at the negotiating table. And there's some very good provisions in the contract. It wasn't like it was a bad contract. 24% increase, 85-15% split on health care, which they preserved. They were able to get some work rules changes. They were able to get 3 unpaid days off. The issue of sick time needs to be, the companies need to sit down with the unions now and have a serious conversation about 2 issues. One is sick days, paid sick days, and the second issue is manpower and power on the rails. They're down about 30% over the last several years, and that's a big issue when it comes to the safety and health of the workers on the job. So I'm going to encourage both sides now to get right back at it. And have those conversations now and move forward in a positive way.
Secretary Walsh, there is a key distinction, an important distinction to make here. It is the way the law can work. It's not necessarily the way the law has to work. You've chosen to make this decision, haven't you? This was a choice.
Well, I don't necessarily. I think there was a lot of factors here too. You're talking about the economy, and you're talking about supply chain, and we've had challenges in our country with shortage of baby formula. We've gone through a pandemic where we had shortage of supplies coming in, and what this would have done to the American people, never mind the American economy, it would have crippled a lot of people because we wouldn't have food. It would have shortened food on the shelves, supplies coming in. This is also as much of making sure that our economy and the American people move forward than anything else too. So again, I'm very sympathetic to the workers out there, and that's why the president, when he, at their request, put the Presidential Emergency Board together, came back with very good recommendations on behalf, not everything, but in negotiations. I've negotiated contracts where I've gotten good contracts. I've negotiated contracts where I haven't gotten everything I've wanted either.
Paid sick leave, it's something you have, it's something that I have. How can those railway workers ever secure the benefits that you claim to support without the credible threat to strike?
Well, I hope you have the companies on this show and ask them that same question and not ask me today after the Congress took action yesterday, because I think that's a very important question you need to ask the companies, why that's not offered to their employees across the board. But in saying that, I intend on sitting down with the companies and talking to them about a couple of things that during the negotiations that I heard from the unions about the concerns that they had about their workers have, and I intend on bringing that up and talking to them about it. And the next contract, this contract expires 2024, so they're already working 3 years without a contract. So as they head into the next negotiation, this should be the top priority. And you don't have to wait for a negotiation. The companies can offer up paid sick time anytime they want.
Oh, you've just made it even easier in the next negotiations, though, haven't you? Because we know the end game here. If you're on the other side of that deal, that negotiation, Secretary Walsh, why on earth would a company sign up to any of that stuff when we know what's going to happen here? Ultimately, they can just say no, and then it comes to the president, and the president says, OK, we'll impose this deal on you.
No, you know how negotiations work. That's not how it works. I mean,
I've just seen how it's played out, sir, in the last couple of months. What do you mean that's not how it works? That's how it's played out.
That's not how it works. The Congress has interacted over 18 times with a PEB recommendation. In 1992, they recommended a PEB. Congress enforced a PEB that was not pro-worker at all. It didn't have wage increases, didn't have preservation of health care, premiums. It didn't have work conditions. It didn't have unpaid days off. It didn't have any of that. And Congress came in. And again, this stuff has to happen at the bargaining table. And that's why the companies need to come to the bargaining table a lot earlier. In this particular case, they didn't come to the table till I think 18 months after the contract expired.
And they won.
And we've had the. No, they're going to have to. I think that they you know, a lot of the CEOs have made comments already about the need to better relations with their workers in the unions on their jobs.
Secretary Walsh, you and I can go back and forth on this a lot. The President of the United States intended to be, quote, what he said, his words, the most pro-union president leading to the most pro-union administration in American history. The fact of the matter is, when it came down to it, you forced union members to take a contract they didn't vote for. How do you explain this in any other way, shape or form? I just don't understand it.
The President of the United States of America is very pro-union. There's no question about it. He talks about it very publicly, and he's very proud of that. He's also the President of the United States of America. And when you look at what the devastation a national rail strike would cause America, that far outweighs the cost of moving forward. The President put together a PEB. There's a lot of benefits in that PEB, good provisions in that PEB that are going to benefit these union workers out there, and there's no question about that. I'm a union worker, a union member myself. I understand that. And at the end of the day, the President got a very good deal on the table for the workers. However, the workers wanted more in that deal, and I can understand and sympathize with the workers. But what we'll do is we're going to continue to work now as an administration to make sure that we help them achieve their ultimate goal.
What message do you think this sends to the ongoing labour contract talks with West Coast dock workers, Secretary Walsh?
I mean, the West Coast dock workers, they're in current negotiation, and they have their own bargaining issues that they're working on, and they're moving forward on that issue. They're having those conversations, those dialogues. The difference is the companies in the dock workers came to the table at the beginning of the negotiation, not halfway through it.
You've been quite constructive on how these talks will go on the West Coast. What are the lessons learned, Secretary Walsh, from the last couple of months with the railroad workers, where you were also equally constructive on how this would turn out? What are the lessons learned for you personally over the last several months?
Unfortunately for the rail unions, I didn't really get involved until pretty much they were 80% through negotiations, meaning they were not able to get deals done. I got involved a little bit there. Then the unions came and asked the President to put the PEB on the board, and they were able to negotiate stuff. And on the port negotiation, I've been in it from the beginning, meaning I've had conversations with the companies. I'm in regular contact with the companies on the West Coast. I'm in regular contact with the unions on the West Coast, just to make sure that they're moving forward. And I think that the relationships are a little different than between the rail construction, the rail companies and the rail workers unions.
Secretary Walsh, I know you have to go, sir, because there's a bill to sign with the President of the United States at 10:15 Eastern Time, and you've got to run. We always appreciate your time. Thanks for being with us this Friday morning. Labour Secretary Marty Walsh, following what was a tremendous jobs report. Mike McKee's alongside us, and Mike, I want to talk about labour leverage. Do we have the leverage in this labour market that we thought we were going to have, Mike, this year?
Well, to a certain extent, we have more leverage than ever, or at least in many decades, because right now we're seeing average hourly earnings rise significantly still because employers can't find workers. 10 million jobs still open. And that means that if you're in the labor market and looking for work, you can generally get higher wages. The numbers that have been calculated by ADP and by the Atlanta Fed, 6 to 8% increases per month to get people to come to work, and we saw that in the wage numbers today.
Seeing this headline as well, crossing about 10 minutes ago, JP Morgan, Bank of America, Citi, slashing banker bonuses, the talent war ending on Wall Street. We're going to have a ton on this later in the day for you on Bloomberg TV and on Bloomberg Radio. Up next on this program, we'll run you through the trading diary about 23 minutes into the session. Equities on the S&P off the lows, but still down a little more than 1%. From New York, this is Bloomberg.